All right, we will go ahead and get started. We will see, I'm sure other people will be trickling in here as they become available. So like I said, if you want to enter any questions into the chat or the Q&A down at the bottom, that would be perfect. We'll try to answer them as we go along. Once again, my name is Kyle Kite, and I'm with Klaas Financial, and we also have Nate Bribey here as well, who will be presenting. Most of you are members over at Members Alliance Credit Union. We've had a wonderful relationship with them for probably close to 20 years at this point. So you've probably seen our name around there. Maybe you've come to one of our presentations in the past when we used to be able to do these in person, but now we're doing them virtually. Hopefully we'll get back to in person at some point in the near future. Like I said, I'm with Klaas Financial. We've been in business for 45 years. Primarily in the Rockford office, but we also have a second office up in Madison now. We've been up there for about 15 years. We have about 20 employees overall, and we've been, like I said, in Madison for 15 years and down here in Rockford for about 45 years. We are what they call an independent wealth management firm that specializes in retirement planning. So again, independent means we're not connected to any bank necessarily where we're attached to them and we have to use certain investment products or sell certain things or anything like that. So we definitely like being independent. Like I said, we've had a great relationship with Members Alliance for a number of years. So we're very happy to have all of you guys here with us. We have three divisions that we help individuals individuals and families through. So we have our Cost 360 division, which is what we call a fee for service division. So in that division, that's for people that are kind of more do-it-yourselfers. They like to manage their Vanguard or pick their own stocks or things like that, and they want our help once in a while. So in that division, we can charge hourly. And then we also have our KIP division, which is Klaas Investment Portfolio. So that's by far our biggest division and the one that most people are the most familiar with when it comes to working with a financial advisor. So in that division, we charge just a flat fee depending on the assets under management as a percentage of the account values and things like that. So again, we truly can help everybody. It just kind of depends on what you're looking for with us. Like I said, we do specialize in retirement planning. So some of the stuff we're going to cover tonight is going to be some of the most pertinent information that we get asked all the time, as far as when do I turn on Social Security? What do I do with my 401k? What's the difference between a pension and a 401k? We'll talk a little bit about some estate planning, which is like trusts and wills, and then we'll also get into a little bit of Medicare and health insurance and stuff like that. We are going to keep it pretty high level tonight. So again, so many of the things that we're going to cover are going to be based on an individual's situation. So again, it's very hard to make blanket statements with a lot of this stuff, but we'll try to at least give you some good information to get you thinking. And please don't be afraid to reach out to us with any questions or go on our website as well. We also host a radio show every Thursday morning out of Madison on WIBA, but we actually post all of our recorded shows on our website. So in those shows, we cover a lot of these topics in a lot more depth. So again, we touch on the Social Security and IRAs and all kinds of different things. So if you're looking for more information, please visit our website. We've got a lot of good stuff up there as well. So we will talk about retirement. So what is retirement? I was reading a book, well, I guess it was last year now when we were all in quarantine. And the author defined it as funded contentment. And I thought that was a really good way to explain what retirement is, because retirement is different for everybody. So some people want to be world travelers and they want to spend a month over in Europe or whatever it is. Some people just want to take road trips around the US or buy that RV that they've always wanted, or a camper, and go visit all the national parks. Everybody's going to be different. Some people just want to spend more time with their kids and grandkids. So it's completely different and completely personal to what you want to do. So one of the questions we always get asked is, how much do I need to retire? And the sad thing is I won't be able to answer that for you tonight, because everybody's a little bit different. So everybody's spending needs are going to be different in retirement. It just depends on, again, what you're trying to accomplish. So we'll start getting into some of the meat of the presentation now. So some of the things that we're going to go through tonight, the first couple slides are going to be the tale of two retirements. Then, as I mentioned, we'll look at a little bit of healthcare and Social Security. And then we will talk about inflation and retirement withdrawals and spending, and then strategies for retirement living. So the first one is the tale of two retirements. So what is a bull market, and then we'll look at a bear market as well. So many people hear the term bull market, but may not be familiar with what it is. Back when I was in college, there was a professor that explained it as a bull market. When it attacks up. So a bull market means when the market is going up and to the right, and a bear market is when it's going down and to the right, which we'll talk about in just a second. So in a bull market retirement, this is it can be very, very powerful. The problem with both of these slides, these next two slides I'm going to talk about, is that none of us know what kind of market we're in when we get to retirement. You tend to know what these are after you've lived through them. So the timing of your retirement can make a big difference in your retirement living. So in this example, we're looking at people that had a $500,000 portfolio. So you see 500,000 is their starting nugget there. They're pulling out $70,000 a year in annual income. You'll see there on the right, adjusted for inflation. So that's why it goes up a little bit each year. So $70,000 off of a $500,000 portfolio is about 14%. I don't know any financial advisor that would be okay with their clients pulling off 14%. But in this scenario, if you retired in 91 through 2000s, if people remember that, the market, the joke was that a monkey could make money in that market because it really didn't matter what you bought. It was all going up and to the right. So if you were fortunate enough to retire in 1990 to 2000, you could have been pulling off 14% a year and still ended up with more money in 10 years than you started with. But again, that's not something that anyone would ever recommend, because you've got the other side of it, which is the bear market. So this is the complete opposite, but it's actually just the next 10 years. So again, that last one was from 91 to 2000. This one's from 2001 to 2010. Same scenario. They start out with $500,000 of a nest egg. They pull that $70,000 a year adjusted for inflation. But you'll see the market didn't do anywhere near as good as what it did during the 90s. And they actually run out of money, just over 7 years here. So again, this is why it's so important to have a strategy for retirement and know exactly what we're trying to accomplish, and not base everything on the stock market. If your retirement lives and dies by how much the stock market returns, you could be in a world of hurt. And this is why planning for retirement is such a big thing. Because again, none of us know what market we're going into. Nobody has that crystal ball of, where it's going from here or where it's going the next 10 years or anything like that. If somebody does, they can say they can guarantee you what the market's going to do for the next 3 to 5 years. You should probably run away, because they probably aren't being truthful to you or looking to get you into some shady things possibly. So be very, very careful. All right, so next we will switch gears into healthcare and Social Security. We'll go into more depth on the stock market, guys, here in a little bit. I know that's a big concern for a lot of people, and we'll talk about ways to kind of protect yourself throughout retirement as well. So healthcare and Social Security, these are probably two of the biggest considerations that clients are concerned about when they're looking at retirement, because we all know healthcare is very, very expensive. For those of us that have had any health issues, or you pay those big out-of-pocket costs with your insurance, even if you have health insurance, it can still be very, very expensive. And many people get into long-term care nursing homes down the line, which is what we'll talk about a little bit too. So when it comes to preparing for retirement, the question is, how long is retirement going to be? So these are just some of the stats. For a married couple that retire at age 65, if you live to age 65, there's a 25% chance that at least one of you will live to age 90, and there's a 10% chance that one of you will live past age 95. So the average life expectancy are those top two arrows up there. So you see age 84.3, that's the life expectancy for a male, and 86.7 is the life expectancy for a female. So if you retire at kind of a standard age of 65, you're looking at probably at least a 20-year retirement, and it could stretch as long as 30 years. I've got clients that are actually have been retired longer than they were working, because they've been retired for 35 and 40 years. So hopefully you're fortunate enough to live a long, healthy life, and that can be you as well. But so many people, 43% of the people underestimate their average life expectancy. So this is a huge deal when it comes to retirement planning, because if we're building a plan and you think you're only going to live till 80, and you're trying to spend your every dollar down to zero at the time you reach age 80, Well, what happens if you live to age 85 or 87 or something like that? So you just really want to be careful with undershooting your life expectancy. We really want to be more conservative if we can. So we want to, typically when we're running projections and plans for people, we're looking out to age 95. Again, a lot of people don't quite make it to 95, but we do have a number of clients that do. I've got one client in particular that still gives walking tours around her neighborhood and volunteers on the Coronado and all that kind of stuff. And she's 96 years old now. So it does happen. And if you take care of yourself, there's a good chance. So again, we want to get to the end of life and still have a little bit of money left, as opposed to running out and just banking on kids to take care of you or living on solely Social Security and things like that. So with living longer comes probably higher healthcare costs. So this here is the long-term trend in healthcare. So that green line is inflation, which is often measured by the Consumer Price Index, CPI it's called. And then the purple line is how the same increase of healthcare expenditures. So you can see that healthcare has gotten way more expensive at a lot quicker pace than what actually inflation historically runs. So this is going to be one of the biggest factors that people need to plan for, is healthcare. Now, fortunately, when you turn 65, you get onto Medicare, and most people, if you've got your credits in and all that kind of stuff, qualify for Medicare Part A and Part B through the government. So that's commonly called Original Medicare. So Medicare Part A and Part B, that covers about 80% of most of your healthcare costs. So we like to say that once you get onto Medicare, that's kind of the promised land, and it's probably the best health insurance that you've ever had, because it does cover the vast majority of what you would come across. Something that they do not cover, however, is dental, vision, and hearing. So those can be very expensive for anybody that's had to buy hearing aids or had to look at them for parents possibly or something like that. It's not unheard of for those to be like $8,000 and things like that. So they can be very, very expensive. So Medicare A and B, like I said, covers about 80%. And then most people will be looking at either a Medicare supplement or a Medicare Advantage plan. There is obviously people that qualify for veterans benefits. There are still some employers out there that will allow you to keep health insurance, although that's becoming less and less common as we move along into time. So most people, again, will get onto Medicare and get Medicare supplements. And we can talk about those in more detail if you guys would like. But typically, if you're turning 65, there's a lot of people that know it, and you're probably getting bombarded from insurance companies and AARP and everything else of all their great Medicare products that they'd be happy to help you. So we don't sell insurance. We're not insurance agents. I used to be one, which is part of the reason why I have a lot of knowledge about this topic. But it's very, very important for you to sit down with a trusted health insurance agent. And especially if you're going to retire before age 65, that's where we get into the Affordable Care Act and Obamacare and stuff like that. So that can be very, very expensive. So for people that are looking at retiring before 65, that is typically our biggest question is, what are we going to do about health insurance? Because it can be very, very expensive. Now, there are different things that you can qualify for out there, subsidies through the federal government that can help and things like that. But it is all based on income and what type of income, where your money's coming from and things like that. So again, we can get into a little more detail with those, but it does get pretty down a rabbit hole, and it is very, very, on an individual case by case basis when it comes to that health insurance stuff. So any questions yet, Nate?
Nothing through the chat. Nope.
Okay. All right, so we will again switch gears and get into inflation and spending. So on that last slide there, you remember seeing that line of the CPI, which is the inflation measure. So we like to call inflation kind of the silent killer, in that you don't really see it on a day-to-day basis, but most people have realized it, right? Most people notice this when they go to the grocery store and they say, see how much a gallon of milk costs now versus what it cost 20 or 25 years ago, right? That's the firsthand account of inflation. So these are just some numbers. A new house back in 1968 was $14,950, and this is just throughout the United States. In 2018, the new house is $302,400. So again, that's a significant increase in housing costs. And if they were to take this as of right now with the housing market, for anybody that's looking at houses or possibly selling a house, you know that this number is probably going up over the next couple of years with where housing prices are at currently, especially in our area here in northern Illinois and southern Wisconsin. Same thing with a gallon of gas. This is always the one. People remember paying 34 cents, 40 cents back in the 70s before the oil crunch. And now this was in 2018, it's at 225, but I just filled up the other day. It's over $3 again. So again, obviously gas fluctuates quite a bit, but again, that's mostly inflation that you see there. Same thing with a new car. So $2,800 back in 1968. In 2018, it's 35,000. And if any of you have went car shopping recently, that's probably a little low, and you get some sticker shock nowadays too, looking at these vehicles nowadays. So again, that new car is something that we have to plan for in retirement. You know, usually many people will keep them for 5 to 10 years, but it is a big expense when it comes up. So we want to plan for those as well. And then as you'll see there, the income the average income has gone from just under 8,000 to 61,372. So if you notice, that's not quite tenfold, where all these other ones up here are pretty close to tenfold, if not more. So they tend to rise even faster than what the average wages do. So inflation, remember, is just what a dollar buys today is going to be more than what it will buy in the future, right? So if you've got a dollar today, you assume inflation, historically it's run around 3%. So that's what we use for projections and things like that. So if you've got a dollar today, it's only worth 97 cents next year, right? So that's, again, we haven't seen inflation for the last few years, but it is something to be aware of, and it will rear its head again at some point. It's just a matter of when. So it is something that we want to account for. But when it comes to, you know, inflation and living expenses rising each year, it's not like clients that are in retirement call us up on January 1st, say, hey, Kyle, I'm ready for my 3% raise because of inflation this year. Typically, once you get into retirement, your expenses will be fairly stable, especially if you've planned appropriately and have gotten yourself where you need to be. One of the fastest ways to retire is to have no debt. So again, if you've got no debt, if you were to look at your budget and take out your car payments, if you have them, you know, your mortgage, if you have them, some people still have student loans. That's where you can see what it truly costs to function and run your household. So food, groceries, going out to eat a little bit, those types of things. That's kind of your base expenses that we really want to focus on. And then kind of the gravy on top is your traveling and all that fun stuff. But you do want to assume some form of inflation because, again, we know that things get more expensive over time. That's just the way it's been. Okay. So the next one is expectations versus reality. So this is a really, really good slide. I like this one quite a bit. So when we talk about retirement planning, we want to set what our expectations are. People that are retired and think that they're going to make, you know, their retirement's based on 10% stock market returns for 30 years, they're probably setting themselves up for failure because the market does not do that consistently over a long period of time. And that's with a lot of different things. If you think you're going to be a world traveler and you don't have anything saved for retirement at age 60, you're going to be hard pressed to save enough in the next 10, 15 years, however long you want to work to make that happen. So 68% of workers expect to work for pay during retirement. So that could be, you know, maybe they enjoy their job or they plan on getting a part-time job and, you know, because they want to work at a golf course. I know that's what I would do to get some free golf and things like that. So 68% of people expect to work for pay, but only 26% actually do. Now, this is for a variety of reasons. Maybe you just realize that you don't like getting up that much in the morning and being told what to do, or it could be something as severe as a health issue or something like that. So again, 68% think they're going to work for pay versus 26% that actually do. That's a big planning aspect, because if your retirement plan is based on you thinking that you're going to continue to work a little bit and make, you know, $35,000 a year, but you have a major health issue, or it might not even be you. Maybe you're forced to take care of a family member or, you know, a mom, a dad, or something like that, that could force you to not be able to carry a job. 53% of people expect that employer-sponsored retirement savings are a major source of retirement income. So that's 401ks, pension plans, 403bs if you work at a nonprofit, things like that. So 53% expect that it will, but only 24% report that employer-sponsored retirement savings are a major source of retirement income. So this one is going to be mostly probably behaviorally, in that people don't save as much as they think they're going to. So their 401k is not quite as big as they thought it was going to be. Or it could be, you know, if they're unfortunate, maybe they were banking on an employer's pension and that employer had issues, and no longer is able to fulfill their pension obligations. So they have to get bailed out. Stuff like that can happen as well, of course. So, and then the final one is Social Security. So only 36% of people expect that Social Security will be a major source of retirement income, versus 67% that report that Social Security is a major source of retirement income. This is, again, a big one. Social Security was never designed to be your sole income source in retirement. It was designed as a supplement for either pension plans or nowadays 401k plans that you put aside. So if you look at how much money you earn, it's not going to be anywhere. Your Social Security benefit isn't going to be anywhere near what you're earning right now. So if that's what you're banking on to live on in retirement, again, you may not have that type of retirement lifestyle that you had hoped for. So again, we want to be really realistic with ourselves on what does this look like, and what's this going to do for us.
Kyle, do you know the max Social Security off the top of your head? Is it about under 3,000 a month, right?
It's right at 3,000 a month, 2,980 or something like that. So
the most 36,000 a year at that 35, you know, if that at the most, just to get an idea of the most it could be if you made quite a bit of money for quite a long time.
Yeah.
Generally, we see it in anywhere from 1,000 to 2,000 to 2,500 maybe a month, depending on work history. So just to give you a ballpark.
Exactly. Yeah. Social Security. So the way it's calculated, there's a lot of misconceptions out there on this too. So it is calculated. They use your 35 years of highest earnings. So it's not the last 5 years like some pension plans or anything like that. They use your 35 years of earnings. They take the highest 35. So this is why you will see people that even though you're continuing to work, this is part of the reason why your Social Security goes up a little bit every year. It's probably because if you're in your early 60s and still working, you're more than likely making more money now than you were 35 years ago, even adjusted for inflation. So your Social Security benefit does continue to go up each year. There's also something called delayed retirement credits as you get into retirement. So delayed retirement credits are what Social Security grows by each year. So from the age of 62 to 70, it grows at 8% a year every year you don't take it. So if you think about that, depending on how you look at Social Security, there's not any investments that we can guarantee you an 8% return every single year, right? So to let it sit and grow for up to 8 years at 8% a year can be pretty impactful for people. Now, there is the other side of that usually you want the money when you're younger and healthier, that you can do it and have fun with it and things like that. But when it comes to planning, this is something you really want to take into consideration, because it can be a significant difference from taking it at 65 versus 70 or anything like that. And remember, the earliest you can take Social Security is 62. So that's kind of, there's three big ages when it comes to retirement for a lot of people. 60, well, I guess there's a couple more than that, but 59 and a half is the first one, because that's when you can actually take money out of an IRA without penalty. So 59 and a half is kind of the first trigger for some people. Then the next one is 62, because that's the earliest you can pull Social Security. Now, if you take Social Security at 62, it is a reduced benefit. So it's reduced off of your full retirement age amount. And they also put a limit on how much income you can make if you start pulling it before that full retirement age. So most people's full retirement age now is somewhere between 66 and 67, just depends on the year you were born. And if you're younger than, I forget the last number, but most people younger, if you're under the age of 60 right now, it's going to be probably 67 for most people. I think, I can't think of the exact year when they change, but somewhere most people between 66 and 67 is what they would call your full retirement age. So why that is important is that is when you get your full PIA, they call it. So that's what your Social Security full amount is called, a PIA. So when you turn your full retirement age, you can take that full amount and also make as much money as you want. For those people that do plan to continue working in retirement and pull Social Security, you can kind of, some people call it double dipping for a little bit if you really wanted to make money and also pull your Social Security. And finally, 70 is a big one because that's as long as Social Security will grow. So you get those 8% bumps all the way up until age 70. So once you reach age 70, there's really no reason to let your Social Security sit because it's not growing anymore at that point. So you might as well turn it on at age 70 in most circumstances. The age I skipped over was 65. So 65 is the Medicare age, like I talked about a minute ago. That was also when they first designed Social Security, that was the full retirement age. It was 65. So basically, you went on to Social Security and Medicare at the same age. But that's one of the changes that they've made with Social Security and will likely continue to make is keep pushing back that full retirement age from 60. Now it's like I said, 66 to 67. That likely could continue to get pushed back. So for those of you that have paid attention and hear that Social Security is running out of money and it's not fully funded and all that kind of stuff, I would say it's unlikely that it goes away completely. Is there going to be some tweaks? Probably. And that's an easy tweak where they could just keep pushing back that full retirement age for younger folks like myself, or maybe your kids or grandkids or something like that too. So, okay, now we will jump back into withdrawals. So go ahead, Nate.
Yeah, yep. This is a good one. So we're looking at comparing different spending levels in retirement off of a $1 million portfolio. So, I think we all may see either in a magazine or online or in the newspaper or something, these different attention grabbing headlines, right? You have to have X to retire, right? Is X $500,000? Is it $1 million? Is it $2 million? Right? And I think, we all get caught up in what do I need to have saved, right? That's usually the first question when Kyle and I are meeting with a new client is, do I have enough? And it could be, for different people, it's different levels, right? $250,000, $1 million, 2 million. And the answer is it all comes back to your spending levels, right? Like we're talking about here. So, take a client who, in this case, starts with $1 million and only needs to take out 40,000 a year, adjusted for inflation, and they're making 5%, right? That's the green line. So we steadily see over 20 years, that is going to be just fine for them, right? $1 million for them, making 5%, taking off 40, adjusted for inflation. We don't see any issues with that line. The different client who saved up $1 million and wants 80,000 because they have more traveling goals, want to buy a second home, you name it, whatever the expense is, making 5%, adjusting that 80 for inflation does not work out in their favor, right? So just coming in with and what amount do I need all comes back to your situation, right? What are your spending goals? Do you still carry a mortgage, that you have to pay off? Do you still carry some credit card debt, a car loan, some of those fixed expenses that we got to be aware of? The other side to this is the income sources, right? We just talked about Social Security. How much are those for you and your spouse? We want to see how strong are those benefits. If those are strong benefits, maybe potentially you need a lower amount, right? Because we have a higher fixed income coming in. In addition to pension, say you have $2,000 in Social Security, another $3,000 in pension. Well, there's 60,000, 5,000 a month, 60,000 a year. Kyle, we would say that's as good as what a $1.2 million portfolio just in fixed income. So a lot of that comes back to your spending levels and your income sources. So go ahead, Kyle.
Yeah, that's why it's so hard to say what that perfect number is. Like Nate said, a lot of times, I remember Money Magazine always says, is $1 million enough to retire, or is it 2 million, or whatever the case is? And like Nate said, it's all about what other income sources you have and how much, what you're going to be spending. So that's very, very important.
We did have one question here that popped up, and the question is in regards to pension. Asking if you should take a lump sum or a monthly option. So we get that quite a bit. And if I could start and you can fill in if you want, or if you want to. Okay. So yeah, just kind of like we talked about, it would be, kind of based on your other, your situation, right? What other investable assets do you have? Do you have, cash in the bank? Do you have other retirement assets for liquidity? That would be the first thing we'd want to know. How much are they offering for a lump sum versus how much they would guarantee monthly. We'd kind of look at some math to see how much that would be. We would want to look at your other income sources. For example, are you eligible for Social Security? Will that replace most of your expenses? Or is this your only income source? If this is your only income source, we may consider taking the pension. Another thing would be behaviorally, if you're more of a spender and you all of a sudden take a lump sum and have $1 million at your disposal, versus rather only having 5,000 a month, behaviorally, it may make more sense to take the pension and kind of put you on a budget. So go ahead, Kyle.
Mhm. No, I think you hit it really well. Again, this is like so many of these topics we're going to cover. It is completely dependent on your individual situation, and it depends on what your goal is, along with what other assets you have and things like that. If your goal is to maximize every dollar of income I can when I'm alive, then taking the monthly annuity instead of the lump sum might make sense for you. However, remember that when you, and if you have a spouse, when both of you are gone, that whole amount is gone. So you can't pass on that $5,000 or $7,000 a month to your beneficiaries. Whereas if you take the lump sum and you have enough other expense, you have enough income coming in, or we don't have to pull off of it very hard to meet our living expenses, then there's a good chance that you could pass on a good portion of that lump sum to heirs or charities, whoever you want it to go to. So it is truly an individual decision, and we run different analysis and kind of show you exactly what makes sense for you and kind of talk through it. It's a great question. I know, especially for people that work over at well, now it's Raytheon Technologies, I guess. It's changed names a few times over the years, of course, but I know they just started doing that back in 2016. I think was the first year they allowed you to take a lump sum for the pension. And there's multiple pieces of that pension depending on how long you've been there and things like that as well. So again, with this great relationship we've had for Members Alliance, we've worked with a lot of people that work from Collins over the years and Raytheon. So we've got a lot of experience with that pension plan and would be happy to kind of walk through your options and kind of do it on a more individual basis as well. So.
Good. Yep. So this one's talking about different allocating your assets in retirement, right? So in the previous two examples, we've used 5% kind of as a growth rate, right, on your assets. And my next question will be, well, great. Well, where do I get 5%, right? My bank or my credit union is not paying me that. How do I kind of get that or potentially more? And we break it down kind of in three basic asset classes, right? You have your stocks, you have your bonds, corporate, government bonds, treasuries, things like that, and your cash, right? Your emergency reserve at the bank or credit union or under the mattress, wherever you put it, things like that. So along with those asset classes, there's obviously a different expected return. So the green line, especially now, is cash. We're not expecting much return on our cash. If we get 0.5%, we're happy in today's day and age. So not a lot of ups and downs with the cash. That's pretty steady with interest rates there. Next, we'll look at the bonds. Those are more steady. Obviously, they're not fluctuating with the stock market. Bonds are tied more to interest rates. Right now with interest rates so low, bonds aren't paying much as far as a coupon and interest rate. And further, if interest rates creep up, which eventually they will, that kind of pushes bond prices down. So that's where you kind of see a dip here towards the end of last few years. So bonds and interest rates tend to move inversely, and that's something we look at too. And obviously, as we're all familiar with the ride the stock market kind of took this time last year, the orange line here has the most fluctuations as far as a risk level, right? We're all familiar with that. Stocks return the most generally over time, but obviously fluctuate the most. So the answer, what we're trying to say here, there's a combination, right? We obviously want to be diversified in our portfolios, especially our retirement portfolios, and we work with our clients in finding that right mix because, we want to take as much risk as needed to reach your goals and not a cent more. So, whatever we kind of need to replace your income or accomplish your goals, that kind of sets your portfolio. And once again, kind of with all these great questions we're getting, it's specific to your situation, obviously, and things like that. So, especially if you work for a bigger employer and you're friends with Jimmy and Joe down the hall, and they may be in the same situation as you or completely different, and they may be invested differently. So, If you talk to your neighbor about what you should do with your pension, or when did they claim Social Security, I would be careful following your neighbor's advice with some of this stuff, because their situation's different, and it's hard to kind of gauge what you should be doing with any of this stuff, without really looking at your specific situation there. So.
Mhm. And by far this asset allocation that we're talking about here, how much stocks versus bonds versus cash you have, that is going to be your biggest determinant of what kind of return you're going to get. It's not the individual securities. It's what's your mix between stocks and bonds and cash, right? So yes, if you own 100% stocks, you're going to make more money than somebody that's sitting on the sideline in cash. So this asset allocation is the biggest factor to determining your returns, not necessarily what individual S&P 500 mutual fund you pick or anything like that. This is the biggest thing to get right. And you also, for those of you that maybe set up your 401k when you first got hired 20 years ago and haven't touched it, you may have started out really, really aggressive, and you've had a really good run over the last, 12, 13 years here. But as you get a little closer to retirement, it's time to start looking at making some tweaks possibly, which we'll cover on this next slide here.
Yep. So this is talking about the importance of rebalancing your portfolio, right? Just as Kyle mentioned, you may start with a specific mix in mind, and here we're showing, I would call it a moderate portfolio with 50% stocks, 20% cash, and 30% bonds. And if you click enroll on your screen there and let it cook for 20 years and add to it and kind of let it go, eventually, generally over time, just like we covered in the last slide, we see stocks outperform because that's just typically what they've done, and bonds and cash kind of lag behind. So if we fast forward 20 years, all of a sudden you're out of balance. Hence the naming there. What do we do now? Well, we rebalance back to the initial target of 50% stocks, 20% cash, and 30% bonds. And this is important to keep you in balance, obviously, and keep you in line with your goals, because this isn't too extreme, but potentially if this went another 10, 15 years, you're arguably up 2 or 3 risk levels just by kind of not keeping an eye on it too. So that's very important to watch. And Kyle, I'll get your thoughts too, but generally we see these kind of looked at annually, or based on a drift, it's called, if your stocks get out of whack, either plus or minus 5%, kind of as a general rule of thumb to kind of look at potentially doing something.
Yep, exactly. Yeah. So I personally, I review my 401k at least once a year just to make sure that it's still in line with what we've seen, especially when you have a year like last year where the stock market just absolutely ripped up for 9 months. Back in March of 2020, it was down 35%-ish. And by the end of 2020, it ended up 16%. So it had a 50% swing in those 9 months. So that can cause your asset allocation to get a little bit out of whack. So I would say at a minimum of annually, and some people, you want to do it every 6 months, depending on what the market's doing as well. So.
Yeah. And I would just add one thing to be careful of is, in a non-retirement account, doing it less than annually, you generate some taxes due. So be careful of what kind of account you're looking to rebalance, and kind of review with your accountant and your financial advisor to see what makes sense. Perfect. Yep. And so this is kind of a good part to kind of say, well, we covered a lot. Now, where the heck do I start, right? I got all these questions. I may be close to retirement, or it's out further than I may like it to be, but I understand Social Security is important. I kind of got some stuff saved. I understand Medicare is important, but where do I start, right? And kind of the first thing we recommend is 2 documents to kind of put together that we definitely help our clients that we meet with put together. And the first is either a balance sheet or a net worth statement, right? Kind of what we're illustrating here. What are all my assets? Okay. How much do I have in the bank? How much do I have in brokerage accounts, investment accounts? How much do I have in retirement accounts, 401ks, IRAs, Roth IRAs? Do I have any 529 plans for my children and things like that, right? And let's total up all your assets. This is where I'm kind of at right now. And then the other side, obviously, is the liabilities. Am I still carrying a mortgage for a few more years? Is that car going to be gone in a couple of years? And things like that, right? And the balance sheets will illustrate your assets minus your liabilities, will give you a kind of a net worth statement. And that's kind of just a scorecard, kind of where am I at right now, right? And that's, kind of helpful to have put together to kind of look at, where we're at now and where we can kind of improve, and what's the forecast going to be looking like for our situation. So
Mhm.
along with the balance sheet, it's important to put together kind of a cash flow statement. So a cash flow statement is, where is my income coming from? Am I still working now? Do I have rental income? Am I retired and have Social Security and a pension, right? Where's my income coming from? And then obviously the other side is the expenses, right? What do I have to pay for? Okay. We call those our fixed expenses, our debts, certainly. We don't want to get evicted. We got to pay for that. We don't want our car repossessed. We got to pay for that. Our property taxes, things like that. What are my fixed? I like to say my fixed expenses to sit on my couch and look at the wall all day, right? That's my fixed expenses. Then, obviously in retirement, we want to have some fun. We've worked all our lives. We want to start enjoying some of our hard work. So we, have some fun money in there to call it too. Do we want to go out to eat? Do we, how much do we want to travel? Things like that. So there's different parts of the expenses we look at and kind of categorize to kind of get an idea of what cash flow is working for you, kind of month to month there. So.
Mhm. I think this is a good spot to talk about diversification as well. So it kind of ties into the last one with the asset allocation and then the slide as well, which is diversification. So what diversification is many people have heard it as not having all your eggs in one basket, which is absolutely true, but some people have a misconception of what that means. If you have three different IRAs and they all own Apple stock and that's all they own, that's not diversification. You just have three different IRAs that own Apple stock, right? So you want to, especially as people have worked for many years, maybe you've switched jobs a few times, so you have old 401ks out there and things like that. You definitely want to consolidate, simplify, and diversify. We're big proponents of that, meaning let's not have 5 IRAs, let's have one or two. And then depending on what we're trying to do with investment strategy and things like that. And same thing with bank accounts or, all these other things. You don't need 5 savings accounts and, 3 checking accounts and all these different things. Let's try to make things a little bit simpler. And that's typically when people want to do as they start getting into retirement, because whether you want to believe it or not, you will start slowing down at some point and you may start being a little bit forgetful about all these different accounts. And there's been so many times that we've had people come in to talk to us about a retirement plan and they forgot about a pension that they had 25 years ago at an employer that they worked at for 4 or 5 years. So those are big things to kind of keep track of. And if you can keep up with them as changes occur, as you've switched jobs, as you've moved, whatever the case is, you definitely want to keep tabs on that. And it's important that everything that you have is going to accomplish your goals, right? You want to make sure all your money's rowing in the same direction and is working to accomplishing your goals. So having money all over the place in different accounts that it's too hard to keep track of and you don't know what it's invested like, that's not a good thing either. So you want to make things simpler, but still be diversified. So again, diversification is just owning a bunch of different things, but you can be fully diversified inside one IRA account. So, you can own stocks, bonds, cash, multiple different types of each inside one account. You can have international and, different bonds, all that kind of stuff inside one IRA. It doesn't have to be held in 3 different IRAs or anything like that.
Yeah, I would just add, Kyle, that just because it comes on a different statement does not make it diversified. Okay. If you have 3 different brokers or advisors that you work with, you could, like Kyle just said, you can own Apple stock, and guess what? It's still Apple stock no matter what statement it comes from. So I think we get that a lot where we have 3 or 4 retirement accounts and clients are concerned consolidating with in a single account because that's all in one basket, right? Well, depending on if it's diversified properly, you'd be just fine with one IRA. So just because it comes on a different statement, a checking account is a good example. You could have 3 different checking accounts at 3 different banks, but guess what? It's still a checking account, isn't it? So.
Yep. All right. All right. So now we'll talk a little bit about distributions from retirement plans. So this kind of goes back to the slide that Nate talked about pulling the $40,000 a year versus the $80,000 a year and things like that. So the distributions are something that we can control. We cannot control what the stock market does on a year-to-year, week-to-week, day-to-day basis, right? I tell the market to go up every day. It just doesn't listen all the time, right? But we can control how much we take out of these accounts. So for those of you that have done any research, you'll hear the rule of thumb out there is going to be somewhere in that 4 to 5% range for a long-term average. So again, that's kind of what that slide that Nate showed. If you pull in 4%, making 5%, you're probably going to be just fine and not run out of money. If you're pulling 8% and you're only making, 3 or 4, then there's a chance that you run out of money and things like that. So, and there's also something out there called RMDs, required minimum distributions. So many people are familiar with these. If you're not to that age yet, maybe your parents are, and they complain about the government forcing them to take money out even though they don't want to, right? So required minimum distributions, this is something that it used to be age 70 and a half was when you had to start taking money out of these. Now they've moved it back to age 72. So why this is important, and the whole purpose of these distributions are the whole traditional IRA, traditional 401k. So when you put money into a traditional 401k, like at work, for instance, it's usually a payroll deduction. So it comes off of your taxes at the end of the year. And so you've never paid tax on the money that went into there. If it's been in there for 25 or 30 years, it's grown and you've never paid tax on it each year. So at 72 now is when the IRS says, okay, we've let it grow long enough and not pay taxes. We start wanting a little bit of tax money come out of that. It's all based on your age and your life expectancy and account value, basically. So it typically starts around 3.7 to 4%, somewhere in there the first year. And then it goes up a little bit every year. So in theory, as you make more interest and your account value goes up, your required minimum distribution each year is going to go up. So why this is important to plan for is if you've been fortunate and saved a bunch of money into a 401k, these can become problematic down the line because, again, it is all income taxable. So if you've got, let's say 70, or we'll just say $100,000 coming in pensions and social securities, and most of that's going to be taxable, right? And then you've also got, $2 million in a 401k, and let's say they use 4% the first year. Well, now you've got 100,000 coming in plus another $80,000 a year in required minimum distributions. You're paying a lot of tax on that type of income. So it is something to be aware of. And this is where working with a financial planner as you get into retirement is still very, very important. So it's very important that you start early, before you get to retirement so that you can have the retirement you want. But it's also very important as you continue throughout retirement. Life changes every year. I forget. There was one good commercial I just seen from one of the big, I don't know, Merrill Lynch or one of them that said the people keep coming back every year and they have these different plans every single year of how things are going to change. So it's very important that when we set up a plan, we do these plans and projections for people all the time, but they're never exactly 100%. Because life changes and you come up with different ideas and you want to do different things throughout retirement. So it's very, very important to do those types of things. So I think where we'll go from here is we had a question actually before this webinar. Someone had signed up and then emailed us a question about should I be doing a traditional contribution or a Roth contribution? And the answer is it's very dependent on your personal situation, like we just talked about. So I'll explain a little bit about the difference between a Roth and a traditional, and then I'll explain kind of who each works best for. So a Roth 401k has only been around for the last few years. The Roth 401k hasn't been around very long. The Roth IRA has been around a little longer, but still back to the early 90s. So really not that long in the grand scheme of things. So when you put money into a Roth IRA or a Roth 401k, you do not get that tax deduction like you do for the traditional that I was just talking about. So you put money into a Roth, you don't get a deduction on your taxes. However, it grows tax-free and it comes out tax-free in the future. So that's a very, very powerful account for people that can take advantage of it. So typically people that should be taking advantage of Roths are younger people because they have a lot of time to let it grow and grow tax-free. And they tend to be in lower income tax brackets. Of course, if you've got a 22-year-old tech billionaire, this all goes out the window. But in theory, if you're talking about, a more normal type situation, younger people with lower incomes are in a lower tax bracket. So they should probably be doing Roths. People have this misconception that 401ks are investment vehicles. They're not really investment vehicles. They're more tax vehicles. Because again, you're putting money in the Roth case at today's tax rates, but you're pulling it out tax-free. So in a perfect world, you would put money into a Roth at your lower income tax bracket, And when you retire, you've saved up a lot of money or have good pensions, and you're in a higher tax bracket then, so you can still pull that Roth out tax free, which would be great. The truth is also the same for the opposite. So if you do a traditional 401k, the theory behind these was typically when people are working, they're making more income than they will be when they're retired. And so you put money in when you're working, you get that tax deduction. You don't pay tax throughout the years you're working and it's growing, but you do pay tax when you take it out. So that makes perfect sense if that's in fact your situation where you're making more money working, but it comes out later at a lower income tax bracket. The problem is if you're working now, making income, and you want the exact same lifestyle or have the exact same income in the future, well, then that might not have been the best move for you, because you could have been putting it away at the similar tax rate into a Roth, or possibly even pulling it out in a higher tax bracket once we talk about required minimum distributions and that kind of thing as well. So it's very important that neither one is right or wrong. It all depends on your situation, and it depends on your future situation where we think we'll be as well. And tax brackets are a funny thing too. I mean, we're at historically low income tax brackets, so I would think that most of you would agree that they're probably going to go up in the future at some point. They're not going to stay historically low forever. So again, to take advantage of known tax rates today and put money away versus the unknown of the future makes a lot of sense for people.
Yeah, and I would add that too. It's the tax bracket uncertainty, is a big factor, because you can only do so much projecting and guessing before it becomes you have to know, actually have factual data to see what to do. And we know what tax brackets are now, but we obviously have no idea what they're going to be in 10 or 20 years, and those can always change too. So it's something definitely to work with your accountant, your financial advisor on, to run the numbers, because truly it is different for each person's situation, but there is a right answer. It just depends on kind of where you're at. So
yeah.
And Kyle, do you see we have one question in the chat, and then another couple raised their hand so on there too? So
Yeah. So what is IMRF? That's a great question. So IMRF is a pension plan. It stands for Illinois Municipal Retirement Fund. So for those of you that work in government positions, depending on what part of government you're in, you may qualify for an IMRF. So IMRF is a traditional pension plan, meaning any pension plan, I shouldn't say any, most pension plans, you aren't required to put any of your own money away. Typically, the employer is the one who puts it away. So unions work this way, where they have pension plans and things like that. So typically, pension plans, you don't have to put your own money into it. It's something that your employer sets aside for you. When you take that money out, when you retire, it's typically going to be income taxable. So you're going to pay income tax on any money that you get out of it. And I don't believe that IMRF has a lump sum option. I think it's strictly a monthly annuity option at this point. It could change. And then a follow-up question, can you add money to IMRF? No, you can't put money into IMRF by yourself. However, you can open up other retirement accounts for yourself. You can open up a traditional IRA, depending on where you work. If you're in a nonprofit, you could open up a 403B or things like that. So typically, you can't put money directly into IMRF, but you could open up a traditional IRA or something like that. Anyone with earned income can open up an IRA. It doesn't matter where you work. So if you're looking to put more money away besides and have more than just your IMRF when you retire, you could definitely go the IRA route, which I guess we can talk about. The max you can put away into a traditional IRA is $6,000 a year right now if you're under the age of 50, and $7,000 if you're over the age of 50. So not huge dollars that you can put away, but every little bit adds up. And again, if you do the traditional route, you could get a tax deduction today for that. Or if you go the Roth route, it grows tax-free even though you don't get the deduction today. So great questions. IMRF, any pension plan is going to be very specific to the plan itself. So there's not like a blanket statement with all pension plans that they all work the exact same way. But typically, it's going to be a monthly annuity that you don't have to save anything out of your own paycheck. A lot of times they take a certain dollar per hour off of your package and put it in the cases of unions and things like that. But that's a really good question. So. Okay, we have someone that raised their hand, so I will let you talk. It looks like Craig and Sherry Diamond. So let me unmute.
Yeah.
Can you hear us, Craig or Sherry?
Yeah, I can hear you. Can you hear us?
We can, yes. What's your question?
Outstanding. Okay, so let's say I get to my 401k and I'm ready to retire, and I've got to retire, and I roll it over. Can I roll it over to an IRA, for example? And if I do, is that a joint account? Do we need to set it up as a joint account in case one of us passes away, the other one is the beneficiary?
That is an awesome question, Craig. So the answer is yes, you can roll it over into an IRA. What an IRA stands for, though, is individual retirement account. So it cannot be jointly.
Yeah.
So typically you would, if it's your 401k, you would roll it into an IRA for yourself, and then you would name your beneficiary. And if something were to happen to you, your beneficiary, I'm assuming it would be Sherry in this scenario, would take it over. And if she's your spouse, she can take it over as her own IRA when you pass away at that point. Oh. Yep. So that's kind of how it works. And then if Sherry doesn't spend all the money and it gets passed to the kids, then we get into beneficiary IRAs, and the kids would have to open up beneficiary IRAs for that money.
Yep. Okay. And I would just add that two follow-on things there, Craig, are to go from a 401k to an IRA is not a taxable event. So that's called a rollover, and that you don't have to pay taxes on that transition. And then if it goes to a surviving spouse as well, that's not a taxable event either. You know,
just when you pull the money out to live.
Just when it hits your checking account.
Yeah, exactly.
Yeah.
All right. Good.
All right. Thank you very much.
Yeah.
You bet.
Great question.
Just the basic.
Okay. Anyone else have any questions right away? You can raise your hand, or we can, like I said, use the chat or the Q&A down there. Otherwise, we've got a couple other topics we can touch on as well. You guys are doing good. We got some great questions. We're already at an hour, so we don't want to keep you all night, but we'll cover a few more things that we get questions on. So I touched on Medicare. I touched on Social Security a little bit. Another big thing to be aware of as you get closer, well, it's not even a retirement planning thing, it's just good financial planning from day one, is estate planning. So this is wills, powers of attorney, and trusts. We get a lot of questions on this as well. So many people, with kind of the first thing that makes them think about a will is when they have kids, because it's okay, what happens to the kids if something happens to us? So most people at the bare minimum should have a will and powers of attorney. So a will and powers of attorney is the simplest estate planning documents you should have. So a power of attorney, there's two of them. There's a power of attorney for property and a power of attorney for healthcare. So many hospitals now will make, if you don't have a power of attorney, they have kind of like a boilerplate document that they'll make you sign to set up a power of attorney in case something happens if they're doing anything to you. So if you do the power of attorney, we as financial advisors, your banker, whoever wants the power of attorney for property. So that says if something happens to me, I'm incapacitated, can't make my own decisions, who do I want to make those decisions for me? So a good estate planning attorney will set up a minimum of a will and those two power of attorney documents, like I said. Trusts are another big question that we get a lot of times. They're still extremely important, but I will say they're not nearly as important as they were probably 15 years ago. And that's because of where the federal estate exemption is. So the federal estate exemption used to be $600,000. So that means if you passed away with more than $600,000, you had to pay the federal estate tax, which at that time was in the 45% range, I think. That estate exemption has now moved up to $11.5 million each. So a couple can get away with passing on $22 million and not worry about that estate tax. So again, they've kind of fallen out of favor in that respect. However, they are still very, very expensive, or very, very important. When they become important, one of the biggest ones is when we're talking about blended families. So if you have children from previous marriages and things like that, we almost always suggest getting a trust set up, because with a trust, that allows the grantors, which is typically mom and dad in this scenario, to decide how the money gets passed on and to the kids and who gets what. So the reason that's important is that and we'll use Craig's example, if Craig passes away, Sherry has kids, she takes over her IRAs, she could just name her kids as beneficiaries and completely disinherit any kids that Craig had. Most people are not looking to do that. So that's where the trust comes in, and that you could basically set up which beneficiaries get what. And then once both of you are gone, they can't, it's very hard to make any changes to it. It's basically irrevocable, in that whatever mom and dad set up is how this is getting passed out. Another big spot where this comes in is if you have maybe a child or a beneficiary that you think a inheritance will do more harm than good, right? So if you have a child that, let's say you've got $1 million in your 401k and you pass away, and maybe your child has drug issues or spendthrifts or whatever the case is, and you think that would do more damage than good to them, you could set it up in trust to where they can only get a certain percentage per year. And you can say, mom and dad will buy them a new car, but it's not a Ferrari. They're getting a reasonable account. We'll buy them a house. We'll help them with student loans or schooling, anything like that. So a trust gives you a lot of control, even from the grave, with how these funds get passed down. So again, they're, in a perfect world, all of our clients would have trust, because it's just so clean, and there's really nothing that anybody can fight it, because this is exactly how it's set up and you can't make any changes to it. But at a bare minimum, a will and powers of attorney are big. So
Kyle, you touch on maybe with and we do have a comment to touch on too, but having beneficiaries on accounts, how that would be different from what is named in your will, and kind of some things to be aware of there.
Yep, exactly. So any 401ks, IRAs, even your bank accounts are all going to be beneficiary driven, which means whoever you name as beneficiary, let's say you name the two kids 50-50 on the account as beneficiaries, but your will says, no, I actually want it to go to my brother. The beneficiary designations on that account are going to trump whatever your will says. So the vast majority of people's bank accounts, investment accounts are going to be beneficiary driven. The wills are more for personal items and things like that, of who you want to get in your jewelry collection, or your baseball card collection or gun collection, whatever the case may be. So,
yep.
All right. So a comment. From experience, I would suggest you have both a traditional IRA 401k and a non-taxable one. That is a great comment, Bill. So that's what we recommend many people do, because it's a way to kind of hedge both risks, right? If we're putting a little bit into a traditional, a little bit into Roth, then we're hedging no matter what happens with interest rates. We're kind of getting the best of both, or tax rates, I'm sorry. We're getting the best of both worlds. And as financial planners, we are big fans of having levers to pull when we get to retirement, meaning different types of money and where we can pull it from. Because if all you have saved is traditional IRA money, you don't have much in checking or savings, and you want to go buy a new car for $40,000. If we have to take that all out of a traditional IRA, that whole $40,000 is going to be income taxable to you. Whereas if instead we had $40,000 in an after-tax investment account, or in savings, or even a Roth IRA, then we could pull that $40,000 and not pay income tax. So it's a very great comment there, Bill. I appreciate that.
I would add that I think most individuals may get caught on it's either one or the other, right? And especially if you're deferring into a 401k at work, you can do 5% pre-tax and 5% Roth. It doesn't have to be 10 on one side or the other. So there is a combination there that may make sense for your situation. It's not always one or the other, right? There could be a situation where it makes sense to do a little in each, to, like Kyle said, kind of hedge your bets on where tax rates are going to. So
great. Okay. I think we touched on everything I wanted to hit. Does anybody have any other questions for us right now? We'll sit tight for a minute in case something comes through. Again, you can raise your hand or enter it in the chat or the Q&A box down there as well. All right, everyone. I think that's it for tonight. We appreciate all of you for coming. Please don't be afraid to reach out to us with a phone call or an email if you want us to talk about anything further or have any quick specific questions. So have a good night and enjoy the spring. And hopefully we'll get back to doing these in person sometime soon. So thanks, everyone.
Thank you.
thank you.
Bye-bye.
Bye-bye.